Under risk, we'll be seeing this risk management process. Risk management process, it's nothing but it systematically helps us to manage the risk exposures. So there are few steps involved in risk management process. First one is risk identification, and then assessment of risk and potential risk treatment, create a risk management plan, and finally implementing that plan. This is the flow chart for that risk management process. So risk identification, it has two things, that is the sources from where we can identify those risks, source analysis, problem analysis, and then it moves down to assessment of risk, and we have this potential risk treatments, risk management plan, and implementation. So this is how the risk management process it works. The first step in risk management process is risk identification. So we have to identify the potential risk. Either we have to identify those events which when triggered it causes problem, or we have to identify the problem itself. So for that we have source analysis and problem analysis. Source analysis, it can be internal or external to the system of this risk management. For example, stakeholders of a project, employees of a company, weather over an airport, all these things are sources from which we can get information about the problems or the risk. In case of problem analysis, it is related to identity threats. So it's nothing but threat of losing money, threat of abuse of personal information, threat of accidents. All these they come under problem analysis because it speaks of the risk itself. So here our first step is to identify this risk. What kind of risk, whether it is the problem itself or it is some event when triggered it is causing a problem. So if you take for example, when stakeholders they withdraw during a project, it again creates a problem, because if these people they withdraw from the project, there will be less funding for the project. So it is again a risk. And in case of when privacy of information, it may be stolen by the employees even when there is a closed network, that again is a risk. And then when lightning is striking Boeing 747 during its takeoff, that is again a risk. So these are all the possible risk identifications which is done in the first step of risk management process. In case of risk identification, we have common methods for risk identification. So first one is objective based risk identification. So here when any organization or project teams they obviously have objectives. If suppose those objectives are endangered, if something is preventing them from attaining their objectives partly or completely, that is considered as risk. And scenario based risk identification is nothing but where difference in scenario analysis, different scenarios are created. So those scenarios, it may be alternative way to achieve objectives or an analysis of the interaction of forces. So for example, if we take market or battle, in that case these in scenario analysis these different scenarios are created, where in any event that triggers an undesired scenario alternative, okay, apart from those scenario which is created, if anything deviates from that scenario, that will be identified as risk in case of scenario based risk identification. Taxonomy based risk identification is the case where Taxonomy based risk identification, it's nothing but it's a breakdown of possible risk sources. Okay, so it consists of possible risk sources. So based on the taxonomy and knowledge of best practices, this will be compiled. So for example, if you take this taxonomy based risk identification in software industries, it will be found in a particular taxonomy, or it will be found in a particular file. Okay, so that is taxonomy based risk identification. And common risk checking is nothing but, here again in case of software industry, if you take the risk that is common in the software industries are common vulnerability and exposures, those things will be again listed at a particular website of the company. So in several industries, list with known risk will be available. Okay, so common risk, all those things will be identified by them, and those things it would be kept in a particular file or something like that. So that is common risk checking. So with those with the help of those files or with the help of those page, they can check what are the common risk associated with their software industry. And then last method of risk identification is risk charting. So here three concepts is used interchangeably, they are used and they identify the risk. It's nothing but here resources, threats and consequences, it will be used. Okay, so in this case, one, they will begin with resources and they consider the threats that these resources are exposed to and the consequences of each, that will be identified. Otherwise, they will start with the threats. Okay, what are all the threats available, and they will examine which resource will be affected by which threat and what will be the consequences. Or otherwise, they will determine the combination of threats and resources and what will be the consequences out of it. So like that, they will identify the threat. So first one, they will identify the resources and what is the threat that is faced by it and what will be the consequences. Second one, it will consider the threats and which threat will be affecting which resources and what will be the consequences for it. And the third one, they will determine the resources as well as the threats, okay, that will affect which resource and the threats. They will determine the combination of threats and resources which would be involved and what would be the consequences out of that. So these are the various methods or various ways by which they identify the risk. Okay. Next step in risk management process is assessment of risk. So once the potential risk has been identified, the next one is to assess. That is nothing but what is the severity of loss and the probability of its occurrence, that will be assessed. So in case if the loss we are able to calculate, then the measurement will be simple. If suppose whether that event will happen or it will not happen, that itself we are not able to analyze it, in that case the measurement is impossible. And then this risk assessment, it gives information to the management, that is how much of loss it may incur, or what are the possible risks, what will be the consequences, how to handle if particular risk happens. So all these informations will be provided to the management of the organizations. And then several theories and attempts have been made to quantify the risk, that is to assess it in theoretical, in mathematical terms, where several theories have been made. So this is the most important or the most common formula that is being used to measure the risk in mathematical terms, that is R is equal to RO into IE. R here refers to risk, RO refers to rate of occurrence, IE refers to impact of the event. So here in later research, it has shown that the financial benefit of this risk management, they are less dependent on the formula used. Okay, the financial benefit of the risk management, it is less dependent on the formula used, and it is more dependent on the frequency and how this risk assessment is performed. So based on the frequency and the risk assessment is performed, this financial benefit of risk management is shown. So this is with respect to of assessment of risk. The third step is potential risk treatment. So once risk has been identified and assessed, all the techniques to manage the risk, it will fall under these four major categories. So that's nothing but risk avoidance, risk reduction, risk retention, risk transfer. So risk avoidance, it is used in risk management to describe an informed decision, that is not to become involved in the activities that will lead to, that is there is a possibility that it will lead to risk. So risk avoidance is nothing but it is a risk management it is used in risk management, that it describes or it informs that no one should indulge themselves into any such activity that will obviously lead to risk. So it's also called as risk elimination. That is one kind of potential risk treatment. The next one is risk reduction. Okay, risk reduction is nothing but it again involves method that helps in reducing the severity of losses or likelihood of the loss from occurring. Okay, so risk reduction is nothing but it helps us in reducing this risk. Here risk avoidance is not possible, so only possible way is to think how to reduce the losses, how to reduce the severity that is coming out of this risk. So that happens in case of risk reduction. That is one risk treatment. And risk financing concept is there. In case of risk financing, it's nothing but it's a method that is used for payment for losses that actually happen. Okay, there are two types of risk financing. One is risk retention, the other one is risk transfer. So risk retention, it involves accepting the loss when it occurs. Okay, in case of risk retention, we will be accepting the losses when it occurs. So all the risks that are not avoided are transferred or retained by default. Okay, as I already said, if all the risk is not possible to be avoided. So if suppose those unavoidable risk happens, in that case we should be able to know how to manage it, how to reduce the severity of losses. That's what takes place here. So this risk retention, it's again of two types, that is active retention and passive retention. So active retention is handling the unavoidable or unavoided risk internally. That is, they will be handling it internally because insurance cannot be purchased for the risk because it costs too much or because it is much more cost effective. Because of that, insurance is not taken for that particular risk. In case of passive risk retention, it is retaining risk because the risk is unknown or because the risk takes either does not know the risk or consider it a less risk than it actually is. So in case of passive risk, what happens? They are retaining the risk because the risk is not known to them or they won't consider that risk that much important. So that is the case of passive risk retention. So risk retention, it can be beneficial in any of the following ways. First one is when the charge for risk transfer to an insurance company. So in case of this risk retention, there is a charge for risk transfer to an insurance company which is generally 40 to 50% more than is paid in losses. Okay, it is basically a charge is being collected by the insurance company, so it is generally amounting to 40 to 50% more than the losses. So that is again beneficial to the insurance company, and it is inordinately expensive to document and settle relatively small losses, particularly when management time is considered. And the next benefit is the collection of small losses. It can frequently it can have an adverse effect on future insurance costs. Okay, the collection of these small losses, it can frequently have an adverse effect on future insurance costs. So that is with respect to risk retention. And then risk transfer. Here either insurance or hedging takes place. It is a transfer of risk from one individual to another who is more willing to bear the risk. Okay, insurance is the most widely used means for reducing risk by transfer. So the person to whom the risk is being transferred is nothing but the insurance company who is willing to bear that risk for us. So this is with respect to potential risk treatment. The fourth step in risk management process is the risk management plan. Here in this case, risk management plan, it should propose applicable and effective security controls for managing the risk. It's nothing but, for example, if you take computer viruses, we all know there is always a high chance or high risk of computers being affected by these viruses. So it should be mitigated by acquiring and implementing antivirus software. So mitigation of risk is nothing but there should be a selection of security control that need to be documented in a statement of applicability. With that, it will be easy for the other employees when this virus strikes. It will be easy for them to look into the documents and see what were the measures that is being taken when this particular kind of bug affects the computer. So same thing, a good risk management plan, how it should contain a schedule for control implementation, and it should be under the responsible of any person to carry on this risk management plan. Then only we will know whether this risk management plan is being effective or it's not effective, or how far it has an impact on that particular risk or particular problem. And we can constantly have a check over it only if we employ any person upon those risks to look upon how far the plan is being executed, or how far it is providing us the good return. So it is necessary to put a person to have a check over it. So this is what risk management plan states. It's nothing but after identifying, after assessing the risk, and after giving this potential risk treatment, this is how they plan to manage this risk, and that plan needs to be documented. Then only it will be easy for those people who are coming after the people who have executed this management plan. They will be able to identify it easily, and solution will also be provided to it in the right time. So the last step or the final stage in risk management process is implementation of those plans. After creating that risk management plan, you have to implement it. So we should, in case of implementation, the person, he needs to follow all the methods, all the plan methods that is being put up for this mitigation of the risk, mitigating the effect of the risk. So he have to follow all the planned methods, and then this they have to purchase insurance if suppose those risks they are accepted by this insurance company to be transferred to them. In that case, they can purchase the insurance policies. If suppose the insurance policy is not accepting that, in that case they have to make sure they avoid those kind of risks, because these insurance companies, if they are not able to cover those risks, in that case we people, it's hard for us to manage. So those risks, it has to be avoided to the maximum extent possible, that is without sacrificing the entity's goals, and reduce others and retains the rest. So we have to make sure that avoiding that risk doesn't sacrifice the entity's goals. So in that manner, we have to implement the plan which we have created to manage this risk. So after all these, after implementing, after following all the plan methods, after purchasing insurance policy whenever necessary, we have to make sure that we review and evaluate the plan, how far, how effectively it is going on, how effectively it is managing this risk, or how effectively it is avoiding those risks that need to be taken into consideration. So this is how the risk management process works, starting from risk identification, assessment of risk, potential risk treatment, and then we have this risk. We have to create a risk management plan, and then we have to implement that plan. Finally, we have to review and evaluate the plan.